Hello again, everybody. Welcome to this joint EDHECinfra LTIIA webinar. My name is François Berger. I'm the Secretary General of LTIIA. For those of you who might not yet know LTIIA, it stands for Long-Term Infrastructure Investor Association, and it's a association of institutional investors sharing the same long-term DNA as its name implies, and with a particular focus on developing infrastructure as an asset class through various means, but basically supporting data collection and development of analytical tools and performance benchmarks to enable the investment community to better manage, allocate, and measure its performance. Now, in keeping with this mission, since its inception, LTIIA has supported research by academic centers such as EDHECinfra, aiming to promote unlisted infrastructure as a full-fledged asset class. And those of you that are regular participants to those webinars may remember that last year, LTIIA commissioned a study on infrastructure assets drivers of volatility, which was similarly performed and prepared by EDHECinfra with LTIIA support. This year, building up on this study, LTIIA wanted to check the often discussed resilience of infrastructure equity to external shocks in what appears to be a very volatile times economically and politically. And I should say the decision to select this theme was taken even before the latest geopolitical crisis linked with the war in Ukraine. But we wanted to do this as scientifically as possible, supported by large data sets covering hundreds of assets over a long period of time. Hence our request to EDHECinfra to lend its scientific methods and potential to sort of further progress our knowledge in this respect. And again, this fits into our overall mission, which we see as one of our main responsibilities. Just a very quick sort of a final introductory word. While the study confirms, as you'll see when we get into the substance with Frédéric in a minute, what it confirms that indeed infrastructure is resilient to external shocks, of course, with a number of conditions or permitting factors, but basically there is a demonstrated resilience compared to other asset classes. So it confirms those insights about infrastructure overall resilience. We still see these results, even though they're not surprising to us, as timely and important in two main dimensions. The first one is that it takes place at a time of strategic reallocation of assets in many institutional investors' portfolio. With the recent inflationary bout, a big concern for those investors, the trend may be towards increasing weight of real assets, those assets that are seen by 4 institutional investors out of 5 as providing indeed some kind of an inflation hedge. So infrastructure should also benefit from an asset allocation point of view from this trend. And in this respect, this study comes very timely. And this whole trend seems to be supported by the record-breaking levels of fundraising for infrastructure funds during the first half of the year. The second dimension for which we think this study is important and timely is its relevance from a prudential standpoint. And as you may know, there are a number of updating work scheduled by regulators in unlisted infrastructure in the coming months and years, which we believe should benefit from some of the findings or takeaways of this infrastructure to maybe review in a more favorable sense some of the currently applicable prudential ratios or capital ratios applying to long-term investment in infrastructure. I'll stop here for the introduction and hand over the floor to the guy who did the study, Frédéric and his team. Over to you.
Thank you, Francois, and thank you, LTIA, for your support. We're always very happy to work with LTIA because it's a group of investors that's interested in very practical, very usable answers for the market. So that's great for us. And indeed, we've been working together for many years. I don't recollect
Yeah,
really. It's been so long.
7 or 8 years now.
Since LTI was created, really, even before. So, and thank you to our participants for attending today. There's now 130 plus of you, so that's brilliant. So today we're going to talk about something. Well, we're going to talk about resilience, but in terms that may be a little unfamiliar to the infrastructure investment community, because we now have access to such granular and high frequency data, and I'll explain briefly how, that we can bring in statistical terms, statistical considerations that you find very often in equities or bonds or other asset classes, but not necessarily in private asset classes. And this is going to allow us to much better understand what's going on in terms of risk and in terms of co-movement, in fact, so how infrastructure behaves when other things go up or down during a period of 22 years, which when you look at monthly data, starts to be a sufficient number of data points to have robust results, right? So this is us. You've now established that. Okay, so our question in this paper is very simple. It's, again, a question that comes from the market. What happens to infrastructure returns in times of economic crisis, financial shocks, lockdown, or policy regime switch, for example, when you go from lower rates to higher rates. And indeed, for the past 20 years, we've seen quite a few of these shocks. As I'll mention at the end, one of the shocks we haven't really seen in the past 20 years is a big inflation shock. So this is something that remains partly untested, but we have ideas about how we might think about this. But anyway, we have evidence of risk and of shocks, and we want to understand with this research if there's joint extreme risk, right? So we know that things go up and down in various circumstances, but do they do that together? Do bonds and stocks and infrastructure, unlisted private infrastructure? So yes, I'm going to say this again just to be clear at the beginning. This is all the research you're going to see today is unlisted infrastructure equity, right? Not listed. You might sometimes get that impression because of the data, but as I'll explain, this is new data, and it really allows to have a much more risk-focused type of analysis. Finally, as another way to understand our research question is to just ask an even simpler question, which is infrastructure unlisted equity more like equities, more like listed equities, or more like bonds, and more like treasury bonds, or more like corporate bonds, right? So we'll effectively answer that question a bit today. As part of this question, we can already ask, or as a form of answering the question from the front, if you want, we can say, well, what are the most important effects, if you want, when there's a shock? Is it going to be on cash flows? Is it going to be through interest rates, or is it going to be through the equity risk premium? And if you look at some of the research we've already done, we can get an idea. So I'm putting this at the beginning because it will kind of frame our discussion. Because we calculate already for a number of assets, well, in fact, for our entire universe, the impact of changes in dividends or changes in interest rate or changes in equity risk premia, and that's the unlisted infrastructure risk premia, on the NAV and over different different windows. And what you see here, basically, the point of this table is to show you an order of magnitude, right? Which is that over the past 5 years, for instance, the total change in net asset value, so if you look at the left-hand side column, keeping interest rates and equity risk premia constant, the change that's only driven by changes in cash flow forecasts is in the 2 to 3% range, right? So, and that includes moments when cash flow forecasts actually decreased in some sectors with COVID, etc. But there's a positive, there's some growth, there's a positive impact on NAVs, and it's in that sort of order of magnitude. If you compare this with the impact of changes in interest rates in the middle column and changes in equity risk premia in the right-hand side column, you can see that there are potentially much larger effects coming from that. And that's probably not too surprising, because that's the wonder of compound interest, of course. If you change the discount rate, the net asset value can be largely impacted when the duration is high, and infrastructure assets have a high duration, and they have cash flows that extends far into the future. In periods where interest rates are low, the sensitivity to these changes in discount rates is high because of the nonlinear, so-called convexity, the nonlinear impact of interest rates, so on net asset value. So the as a first answer, as an initial answer, we know that when we're going to look at these shocks, we should focus on what's going on in terms of discount rates between different markets, stocks, bonds, and infrastructure. That's going to be quite interesting. So we'll test that in some detail in this paper. The data that we will use is data that we're now applying in a number of research projects. It's data that only became available less than a year ago when we started computing all our results on a monthly basis, use mark to market, right? So that is the EDHECinfra database. We track more than 700 companies over a period of more than 20 years. And every month we have revisions of expected cash flows for all these assets, depending on a number of elements, but all of that validated by human analysts. There's a sort of corporate analysis element to that. Of course, we update the equity risk premia that applies to these cash flows based on the latest transactions that are visible in the market. I'm not going to present today how our asset valuation model functions. I think I've done that in a number of webinars before, but suffice to say that we have this multi-risk factor model, which is capable of pricing different systematic risk factors as we see new transactions come in and effectively recalibrate the price premia. So the price of the size effect, the size of the price of the leverage effect, the price of the profit effect on the risk premia are recalibrated every time. In fact, every time we see a deal, and every month as we observe information from the market. And of course, we also update yield curves. That's more straightforward, I guess. So the yield, the risk-free rate that go into the discount rate, which is the yield curve that matches the maturity of the asset, of the investment of the asset. And so on a monthly basis, we produce a new price for more than 700 companies, which means that if we go back 20 years, we're going to have a lot of data. And again, this is something that is fairly new in the market and therefore allows to do very interesting new research. Now, this data, we're going to want to compare it with something in order to try to answer our question. What happens when there's a shock? So in terms of how we're going to do this, first, all the shocks we're going to look at, we're going to assume, and I think this is reasonable, that they are exogenous to infrastructure as an asset class, meaning the GFC, COVID, any kind of interest rate shock, any recession, none of this is the result of infrastructure investments or infrastructure assets. Instead, it's the stock market itself that is either overpriced and collapses, or the bond market itself, which either reacts to price pressures or interest rate movements, etc. But we can consider all of these shocks to be exogenous, and they just happen, and infrastructure returns react. So we don't need to worry about endogeneity, basically, which is an important point because it's going to make our analysis much simpler. We're just going to look at how infrastructure returns behave when the other asset classes move, go up or down. We're going to take the infrastructure 300 index as the proxy. In the paper, there's a number of comparisons also with subsegments of the universe. I won't cover that today because I need to leave something for you to read in the paper, and also it would take too long. But so we're just going to look at the market as it's proxied by this index, the infrastructure 300, which is widely used now in the market. And we need to compare this with equities and bonds. And I'll show you in a minute with what equities and what bonds. And what I'll show you today is how the return distributions what they look like, what the drawdown of these different asset classes look like together, how they correlate, and what happens when there's a shock to the discount rate specifically, in particular interest rates and risk premia taken separately. Right? So the infrastructure 300, I think many of you know, it covers 20 countries, 27 sectors. At the end of May, it was $220 billion of market value. And that's going to be, again, our infrastructure proxy. And then in order to compare it with other asset classes, we have, we're going to build listed equities, government bonds, and corporate bond proxies, comparables. And here we take the indices that you see on the left, which each correspond to a wide geographic area. So we have the Eurozone, Australia, the UK, and the rest of the world. And why these four? And that's because these are the main four blocks, if you want, geographic block in the Infrastructure 300. We're going to take the same weights over time. So as you can see, the weights by these regions on this chart in the middle. And each of these four proxies on the left, market proxies, will be weighted according to the weights that you see, the colored weights you see in the middle, and that will give us a comparable index. So in other words, I'm going to build a listed equity index which has the same geographic exposures that the Infrastructure 300, a government bond index which has the same geographic exposures that the Infrastructure 300, etc. Same for corporate bonds. We also pick corporate bond indices which have reasonably close durations. Usually you don't report durations in equities. With infrastructure, first you can, because most infrastructure assets have a finite term, so it's easier to compute duration. And it's also very important because that's a big driver of valuations. So and as we'll see, infrastructure has some bond characteristics. So talking about the duration of infrastructure equity is actually very relevant, despite the fact that it sometimes can seem a bit strange because it's a bond concept brought into the equity investment world. But just to make sure that we're comparing like for like, again, we take bonds that have reasonably close duration to our infrastructure equity universe for each region, meaning that when we see a different in behavior, it won't be because they are reacting differently to interest rates. I see that there is a question. Someone raised a hand. But I don't see a question. I'll take your questions at the end if you don't mind, because that might otherwise become. I'm sure to bust the time if I do that, if I start taking questions now. So please ask your questions in the Q&A module, and I'll take them at the end. Right, okay, finally, in terms of approach, what we're going to look at today is the price returns, or the capital returns, if you want. And the reason is that it's a much more straightforward, much more fair comparison between infrastructure and listed bonds, listed equities, and corporate bonds. And that's because cash yield is really much higher in infrastructure than it is in other asset classes. And that's one of the important and very appealing characteristics of infrastructure, but it makes total returns harder to compare because it means the total returns in infrastructure are full of cash yield, effectively. And as you can see on this graph, that's the cash yield of the Infrastructure 300 and of my three proxies that I just described. You can see that over time, the cash yield of infrastructure is fairly stable, pretty much the same as it is for equities, but it's 3 times higher. So first, it's higher than equities. It's also stable, so it doesn't decline like bonds, because there's growth in infrastructure. There's maybe not as much growth as in equities, but there is some growth. So really comparing total returns is not so obvious. It creates a wedge, if you want, between. It makes the interpretation much more difficult. Whereas if you just compare capital returns, it's very straightforward. We'll just be looking at the impact of effectively movements in cash flows, yield curves, and the risk premia on the net asset value of these investments, and ignore the cash yield for now. When it comes to extreme risks, that's really what is most interesting. Now, let's look at how these returns are distributed. So here I want to bring a few concepts. Some of you will be very familiar with that, but maybe not everyone. And also, that's just a way of, because we're going to come back to this multiple times during the presentation. So first, we're going to compare the distribution of monthly prices. Sorry, it says price and total returns here, but actually we're just going to do price returns as such. I'm sorry, that's a typo. And we're going to look at their variance, which is the dispersion of these returns, right? And this is something that dispersion around the mean. This is something that is fairly, in fact, probably the most common measure of risk in in finance, the standard deviation or the variance, the square of the standard deviation of returns. But it's interesting to have that in mind because on this picture, I'm showing you a perfectly symmetrical, in fact, a normal distribution of returns. And we're going to be looking at how things also deviate from that. So that's the first notion we're going to be looking at is how the returns vary. And because we're looking at granular enough data and mark-to-market data, we can really begin to compare the variance of returns. And this is something that we couldn't do before because before we had very smooth appraisal-based returns, which you couldn't compare the variance because the variance was very smooth, it was very low, and you couldn't compare it to stocks, for example. Here, you can really compare it. So that's the first notion I want you to keep in mind, the dispersion around the mean. And this is also obviously what you use to compute the Sharpe ratio, which is also very common in other asset classes, but not always in infrastructure. The other notion I want you to have in mind is skewness. And it's important to keep it in mind because later on we'll talk about co-skewness, and I don't want you to get all confused. Skewness is the so-called third moment of a distribution. It shows you the shape, right, of a probability distribution. And what we're interested in really is negative skewness. Negative skewness means that, as you see on that picture at the bottom, if you go from a symmetric distribution, like I just showed you, which is just some dispersion, right? The skewness is 0. You go to one which is more skewed towards negative returns. It starts to change its shapes. It has more returns to the left of the mean. Okay, and here you can see that the skewness of this particular distribution is negative. It's minus 0.79, but it doesn't matter what it is. What the number is. The point is that when a distribution is negatively skewed, it's possible to have larger losses. Okay, larger losses than gains. Okay, and of course in finance we often find these negatively skewed distribution of returns. So that's and we'll see that they are a reality, of course, in all asset classes, including infrastructure. And finally, one thing to keep in mind, an even more uncommon term perhaps, kurtosis, which is a measure, the force moment of a distribution, and which is a measure of extremity of deviations, right? So that's what you normally use, that's what you usually call the fat tails, which is another term that often comes up in conversations, etc. But what it means exactly is that, as you can see here on this picture, the distribution becomes more kind of squashed and wider, and so we're more likely to have, when we deviate from the mean, we're more likely to have to deviate more from the mean. Effectively, that's what kurtosis means. And we also distinguish between the kurtosis of a normal distribution, which is around 3, and what we call excess kurtosis, which is this minus 3. So it's 0 for a normal distribution, but it's not 0 when there is kurtosis that is relevant really to an investor, because we're looking at returns that are not normally distributed. In other words, they have fatter tails. They are more risky, effectively, than normal returns. Normal returns is the reference because returns in stock markets are pretty normal, not always, but over a long period of time, they're pretty normal. And in many simulations, they're assumed to be normal. But when we look at the reality of the data, it's not always like this. And you'll see that with infrastructure, it's not necessarily like this. Okay, so keep this in mind. The dispersion around the mean, the negative skewness, and the kurtosis, so the fat tails of the distribution of returns. Now, what does our data look like? So here I'm showing you this distribution data for the price returns of our 4 asset classes: equities, government bonds, corporate bonds, and the infrastructure 300. Now, what we see first, if we look at the second row, the standard deviation, so that's the annualized standard deviation, the risk, the most standard measure of risk, you see that infrastructure has a lower standard deviation than equities, but it's still not negligible. It's 9.5% almost, and a higher standard deviation than bonds. Okay, so in terms of dispersion around the mean, infrastructure is somewhere between equities and bonds, which is perhaps not a surprise, and it's often an argument that's made about infrastructure, but here we can prove it. We can prove it with data that is, let's say, robust. And again, until we were using monthly data for 20 years, it was not necessarily the most easy thing to demonstrate. Now we have this information, and if we look at the Sharpe ratio, which is the ratio of excess returns to the standard deviation of returns, you can see that the Sharpe ratio of infrastructure is very high over that period. In fact, it's typical of a bull market Sharpe ratio, what you'd see in other markets when it's that high. That's the annualized Sharpe ratio. And it's much higher than others, and that's typical of an asset class which has done really well during that period. And it has, as we know, it has done really well, in particular during a period where there was a lot of demand for these assets. I'll come back to that also a little bit later. Now, if we look at our skewness, okay, so we see that it's all negative for all the asset classes. So all these asset classes have more negative returns on the left-hand side. When they have negative returns, they have more negative returns than not. But we see that infrastructure is less negatively skewed than equities and less negatively skewed than corporate bonds. On a price return basis, it's different if we look at total returns, but more negatively skewed than government bonds. So here we see that purely on that metric, in terms of extreme left-hand side risk, extreme negative returns, infrastructure has interesting characteristics in the sense that it's again between bonds and equities, but closer to in fact between corporate bonds and treasury bonds rather than between bonds and equities. And now if we look at kurtosis, that's even more interesting. You can see that there is excess kurtosis for all the other asset classes. Actually, there is some for equities, even more so for corporate bonds. That's pretty standard. Very little for government bonds. And in fact, it's negative for the infrastructure 300, meaning that there is no fat tails. And instead, the distribution of return is a little bit more clustered around the mean than if it was a normal distribution. And that's a sign of very stable returns, okay? So here we can see the characteristics of infrastructure start to appear in the data in a way and at a level of sort of precision in terms of statistics, which is quite powerful and will then later allow research to be done in terms of risk management, portfolio construction, prudential research as well, prudential calibrations, in a way that was not possible until now. Now, I'm sorry, this is a little bit busy with all the arrows, but this is the same data, but over time. Right, so here you can see those returns, those price returns for these four asset classes over time. In gray, you have periods of recessions. You also have a few shocks, the well-known shocks that are marked on the chart. And what you can see is that infrastructure returns are more related to bonds in normal times. So if you just casually look at this picture, you'll see that the blue line, which is infrastructure, moves up and down with the bonds most of the time in normal times, but that in times of crises, it tends to move more like equity, like the equities. In terms of market stress, it tends to follow the pink line, which is the equities market, okay? But still, it's not always the case. We also see some periods of market stress, where there are no infrastructure drawdowns, despite the fact that equities are going down. So there's something complex going on here. Sometimes there is correlation with bonds, sometimes there's correlation with equities, and sometimes there's no correlation with much. So let's continue our exploration. But at the moment, we can see that infrastructure is special. It's clearly a different asset classes. It has risk. Sometimes infrastructure, perhaps historically, infrastructure has been understood as having pretty much no risk, or at least no market risk. I've heard people say, oh, infrastructure is all idiosyncratic, etc. Right? So absolute return strategy, because it has nothing to do with what's going on in capital markets. That's was never very convincing if you studied any finance. But here we can see that it's clearly not the case, right? There is negative skewness in the returns of infrastructure. There is some correlation with what's going on in asset markets, in capital markets, but there's lower risk, lower variability of capital returns, no fat tails, and less skewness. Okay, so this is an interesting asset class and a new asset class, a different asset class. And then the way infrastructure returns seem to co-vary with other asset classes over time seems to be dependent on what state we're in. So if we're in a good state of the economy, bonds are more relevant. If we're in a bad state of the economy, equities are more relevant. That's what it looks like when we look at the data, but let's dig a little bit deeper. So now we look at drawdowns specifically beyond the distribution of returns. So drawdowns are the observed losses, and so that's all in sample or drop in value from peak to through until a new peak is reached. So that's a measure of extreme risk on the downside, if you want, but in sample, based on historical data. We can look at the average such number. We can look at the worst one, the maximum drawdown, which is quite a common risk measure as well. And we can look at on the last line, the conditional drawdown, which is basically the average drawdown in this case, 5% worst cases. So that's a bit like a similar notion than conditional value at risk, for example. Right? It's not the one point in the distribution, it's the average of the tail of the distribution in the 5% worst cases. It's also a more robust measure, the conditional drawdown, because precisely is based on the tail of the distribution and not just one data point, one extreme data point, which may or may not be very robust. So if we look at all these types of numbers in terms of drawdowns, what do we see? We see a picture which continues to match what we saw before, right? So there's less drawdown in infrastructure than in equities, but there's more than in bonds. Okay, fair enough. We see that infrastructure has the shortest drawdowns and the fastest recovery. So these numbers, average length and average recovery, they're in months, number of months. So in terms of price returns, again, the infrastructure has the shortest periods of drawdown and gets back to this point or higher, where it started to drop faster than other asset classes, even bonds. So that's an interesting characteristic. And our conditional drawdown measure also shows us this same idea, that infrastructure is somewhere between corporate bonds, somewhere between bonds and equity, and pretty close to corporate bonds, right? Okay, so that's what drawdowns show us in aggregate. If we look at drawdowns over time, there's lots to say. There's a whole lot of analysis in the paper, so I won't go over all of this now because there's lots to unpack. But one thing you can see here is that two of the worst drawdown periods are triggered for infrastructure, which is the blue line now, are triggered by the normalization of interest rates recently, and historically the subprime or the GFC crisis. And clearly the GFC remains the highlight, the mother of all crises for the past 20 years. For infrastructure, it certainly was the worst until recently. The normalization of rates has done a lot of damage to asset returns since the end of 2019. And then combined with the COVID lockdowns, and that has not helped. And then now we have, beyond normalization, we have rates that are expected to increase because of high inflation. So as you can see at the end, all the way at the end of this chart, you have this blue line, that's the current drawdown that infrastructure is going through, along with all the other asset classes. And purely on a price return basis, it's probably the worst time ever. If we looked at total returns, it would be quite different. In terms of total returns, infrastructure would actually have less drawdown than equities or corporate bonds. But I'll let you read the paper to see that. Okay, so what we see in terms of drawdowns, infrastructure appears to be more resilient, right, in terms of drawdowns than equities and bonds. And the transmission mechanisms that we can start to see appear in the data are through the cash flows. We can see that during recessions, which depressed asset values for stocks and bonds, there's some impact on infrastructure. And clearly that will be through the merchant or the regulated types of infrastructure, segments of the infrastructure 300, which are more exposed to the economy and therefore to lower cash flows. in terms of the impact of the risk premium, we'll explore that in a minute, but clearly this risk premium changes over time. It's the price of the risk of the cash flows, if you want. And the expected excess returns of infrastructure investment is a function of investor preferences in the end. It's that we can see that it's a market, right? And so that's something that is not independent across asset classes. When it changes for equities and bonds, it also changes for infrastructure, but to some extent. We'll go into that in a minute. And then the yield curve, well, the yield curve is the same for everybody. And so depending on your horizon, depending on your duration, the impact of the yield curve on asset values will impact all asset classes, and as we see, this will be one of the reasons why we have these joint drawdowns. Now let's go even a little bit deeper and talk about co-movement analysis. So first, let's look at correlations. So we have all these returns, right? We've seen that they have distributions that are different, they have shapes that are different. We've seen that they have drawdowns, extreme risks that are different. Now, if we look at the covariance, or how much they co-vary, that's a very important measure, because that's, in fact, the most fundamental input if you're doing portfolio optimization or portfolio construction. You want to know and how much you want to invest in infrastructure. You want to know how much these returns co-vary, right? So covariance is important, and of course covariance is none other than our old friend correlation, which we talk about very often, but correlation is simply a standardized measure of covariance, okay? So covariance tells us how these either equity returns and infrastructure returns, or government bond returns and infrastructure returns, etc., move together. And again, here, purely on a price basis, we see that infrastructure has higher price return correlation with corporate bonds and equities, and has a lower correlation with government bonds. That's interesting, because it means that there's something going on with the cash flows here. If it was just interest rates that move the price of infrastructure assets, which you might think is the case, because when you describe infrastructure in a very abstract, a priori kind of way, you think, okay, infrastructure has long-term stable cash flows. It's like a bond, right? But there's more going on. Otherwise, it would be more correlated with bonds. And remember that we've matched the duration here of our government bonds and corporate bonds proxies with that of our infrastructure universe. So it's not just the duration that's driving these correlations. It's also something to do with cash flows. Okay. What's interesting here is that the correlations are significant. So there's something, they're real. They actually do move together. And that they're different across asset classes. And that already tells us that there's something to do with infrastructure in our portfolio, because it will, one way or another, add diversification to our portfolio. And if we look at these correlations over time, so again, that's a bit busy with a lot of arrows, but bear with us. Here you have the correlation of the infrastructure 300 price returns, so infrastructure returns, okay, with these three asset classes proxies that we've built, rolling over 60 months, so 5 years. All right, so I take 5 years of data, I compute the correlation between returns with infrastructure, and then I move forward every month with 5 years of data. So here you see basically the rolling correlation. And 5 years of data, 60 data points starts to be reasonably large to compute a correlation between returns, of course, without being too smooth. Now, the green and yellow lines are both treasury bonds and corporate bonds respectively, so that is positive. Okay, so we see that the returns in infrastructure is always correlated with bonds in a positive, irrespective of the time. It's positively correlated, which makes sense again, because we know we have bond-like characteristics in those investments, but you see that it's dynamic, it changes over time. In particular, these correlations with bonds, they decrease, they don't disappear, but they decrease during periods of shock, of crisis. And they increase during periods of economic expansion or inflation, when interest rates increase, okay? So again, it makes sense, right? If these three types of assets, corporate bonds, treasury bonds, and infrastructure, are all exposed to big changes in risk-free rates. And when it comes to equities, it's a little different. We see that it's very dynamic, but it kind of changes signs over and below zero. So if you take the whole series, really, it's pretty much, it's not zero, but it's much lower, and it changes in terms of market stress in the opposite way than it does with bonds. So in terms of market stress, the correlation between infrastructure returns and equities increases and sometimes becomes positive and stays positive for a while. Conversely, there's a period when infrastructure returns are negatively correlated with equities, and that's when there is a strong, pretty what I call the bull market for infrastructure between 2010 and 2015, where returns in infrastructure were so strong that basically they had less to do. In fact, they were negatively correlated with equities. It didn't really matter what equities did. In particular, if equities went down, infrastructure kept going up. But that was just during that period. The rest of the time, the correlations are very state dependent, depending on the state of the economy, but also the excess demand for infrastructure assets, which we think has abated fairly since 2015-17. So in terms of these higher order co-moments, now I'm introducing something even more perhaps unusual or exotic. So we've looked at correlations, okay? Now we want to look at higher order co-moments, which is how these different return distributions move together, not in terms of covariance, because if you remember, correlation and covariance basically the same thing, but in terms of skewness and kurtosis. So now we're going to talk about co-skewness and co-kurtosis, meaning do you see extreme returns, so extreme negative returns, or fat tails also, at the same time in different asset classes, okay? So you can compute that, and that's the, so same logic here, 60 months, so I take 5 years of data, rolling, co-skewness of the infrastructure 300 price returns with capital markets. So here I have my equities in pink, government bonds in green, and corporate bonds in yellow. And I'm computing the co-skewness, meaning the tendency to experience, in this case, either extreme negative or extreme positive returns at the same time, okay? And what's interesting here is we see that the co-skewness also is very dynamic, especially with equities. This matches the understanding we have now that in times of crises, for example, the correlation increases with equities. Well, actually, the extreme returns also increase. So you can see that after the 2008 crisis and pretty much until the 2012 recession that followed, there is negative co-skewness with equities, meaning that equities and infrastructure are more likely to have negative returns at the same time. And then it goes the other way. We have this bull market period during which infrastructure becomes very popular and prices for infrastructure go up a lot. And this is a period during which there's positive co-skewness with stocks, meaning high positive returns in stocks are more likely to be observed at the same time than high positive returns in infrastructure. And then we have COVID in early 2020, and the same thing happens in the other direction again. Right? We see that we're more likely to have negative returns at the same time in equities and in infrastructure, and also in corporate bonds at that period. Now we see that the co-skewness with the negative co-skewness with corporate bonds also increases after 2020, which it hadn't really so far. So that's co-skewness, and we can do the same thing with co-kurtosis. So do we have more or less fat tails at any point in time, at the same time in equities, bonds, and infrastructure? And of course, this is the reverse, right? You remember that negative kurtosis meant high negative returns. or rather very negative returns. Here, high kurtosis means fatter tails, so it's also more risk. So we see positive numbers here, positive co-kurtosis during periods of stress, negative co-kurtosis during periods of high market returns, high market performance, bull market, and when COVID arrives in 2020, very high positive co-kurtosis, meaning fatter tails across asset classes. Right? So these notions allow you to see that it's not just the variability or the correlation of returns, but it's also the tails of the distribution that change over time and that define how infrastructure behaves relative to other asset classes. Again, remember that it does all these things and it does become more sensitive and have more extreme risk in periods of risk, but overall, it's less risky than the drawdowns, for example, are less high than in other asset classes. Okay, so with covariance, we see that it's high with bonds, but it's time varying with the business cycle. It's positive with equities in times of stress, but it's probably close to zero over a long period of time. And in terms of co-skewness, we have more negative co-skewness with equities and to a lesser extent government bonds in times of market stress. And co-kurtosis, we have fatter tails in times of equity market shocks. So again, if you were to build infrastructure investment products and take into account all of these moments of the distribution of returns, now you could do all this. Now, final part, we're going to try and understand how all these movements and co-movements of returns can be explained in terms of either the impact of interest rates or changes in the equity risk premium. Okay, so the link between returns in infrastructure stocks and bonds is partly a question of co-movements of discount rates, and this is what I was showing you at the start. In fact, it plays a big effect. It's a first-order effect in terms of returns, and it's more important than cash flows in that sense. Changes in equity risk premia and risk-free rates impact asset classes together in times of stress or in times of crisis. So we know that from what we've seen now. So let's try and unpack the two. First, I need to build, to understand this, I need to build a measure of shocks in the equity risk premia. Okay, so I'm going to take two time series of equity risk premia, one for infrastructure, which comes from Inframetrics, which we compute every month, which is the blue line here, or the blue distribution at the bottom right, and one for stocks. Stocks, which I'm taking from DataStream. So this is the equity risk premia in stock markets. So these are two different types of equity risk premia, right? One is the implied equity risk premia of stocks globally, and the other one is the equity risk premia that we extract from secondary market transactions in infrastructure every month. And in order to measure to build a shock metric, because these impacts obviously on returns are not necessarily a one-on-one, well, they're not necessarily fully realized in any given month. So we build a 6 months moving average of this 1 month's difference in risk premia. So I take the difference in risk premia, how much it changes every month, and then I build a 6 months moving average of this metric and I call this the shock. So every 6 months, so rather looking back 6 months, how much has the risk premia changed in either unlisted equity for infrastructure or listed equities. So that as you can see, this measure correlates quite well with a number of economic events, financial crises, etc. And now what I want to do is take this measure and see how it correlates with infrastructure returns or with equity returns in that case. So I take my two indices, the infrastructure 300 for equity, for infrastructure, I'm sorry, the listed equities index or proxies that I built before, and I look at how they correlate with this measure of shocks. Okay, and so when there's a shock, and when there's a positive shock, when risk premia increases, the returns decrease. The value goes down and returns decrease. So the correlation is negative. That's always like that, most of the time, the immense majority of the time. But we see that this correlation is also dynamic. So over time, it changes. In times of stress, it becomes stronger. So there's one unit change in risk premia leads to no, sorry, that's not the sensitivity. The correlation, so the co-movement between risk premia is stronger with that of returns, right? In times of crises. And this is very visible in the subprime crisis, obviously, where the correlation increases strongly, but also during the COVID lockdowns, where it also increases considerably. Now we can do the same thing for rates. We can have a rate shock metric. So we take the average change in 10-year bond yield in the 4 different regions that we described before. We take an average of that weighted by the size of the region in the index, and we get something that is effectively a shock to the interest rates in the data. And likewise, compare this shock, the correlation of this shock, with the returns of this time equities, bonds, and infrastructure. So what do we see here? We see that equities have a positive correlation with shocks in interest rates, even though it's declining, which that's consistent in the sense that higher interest rates typically indicate higher economic, this is the 10-year rate, higher economic activity, and therefore it tends to be positively correlated with listed equity returns. Obviously, it's kind of, this effect has kind of disappeared since 2015-16. That's because interest rates are extremely low, and also because you might argue that current levels of interest rates don't necessarily reflect the future. They're more likely to reflect the state of monetary policy. But overall, we have this positive correlation between equity returns and shocks in interest rates. Conversely, you have a negative relationship with bonds. So the green line, which is government bonds, is always negative. So higher interest rates means lower returns for bonds, for government bonds, and that's true all the time. The one that's a little bit bizarre is corporate bonds. Corporate bonds also have a negative correlation with interest rates most of the time, except during that one period between 2008 and 2014, when it suddenly starts to increase and become, in fact, positive during a few years, and then it returns to where it was before. It returns to, it becomes basically the same then for treasury bonds. You see the yellow line kind of jumps up, goes over the 0 line, and then goes back down in 2014, and then finally kind of rejoins the green line. This is just corporate bonds, and that is an indication of a period during which corporate bonds were in great demand, meaning that despite the fact that the price is going up all the time, combination of top other QE metrics, and also investors wanting to buy lots of corporate bonds after the GFC. And that means that irrespective of how interest rates move, the price, or rather the returns of corporate bonds still goes up, right? It's still positive. When you get over the 0 line, that's what it means. It becomes like equities, effectively. And so so this is just a story of what happened to corporate bonds during that period. But what's really interesting here is that the same thing happened to infrastructure. Infrastructure, most of the time, as you see here, has a negative correlation of returns with shocks in interest rates. So infrastructure has high duration. It has bond-like characteristics. So higher interest rates means higher discount rates means lower net asset values. But there is a period during which this relationship is nulled and in fact reversed because infrastructure is in so much demand that its prices keep going up, so the returns keep being positive, despite the fact that during that period discount rates also increase, or if they increase, right? So it's the correlation. So if they increase, you still see positive returns. because during that period, positive returns are very positive. Basically, there's an excess demand for infrastructure, and that effect kind of wears off over time, and now it's pretty much gone. So that's interesting for many reasons. One, it documents, I think, quite well, probably the best, this notion of a bull market in infrastructure during that period. It also highlights why some of the past drivers of infrastructure returns may not be useful when it comes to expected returns today, because some of these effects are not coming back, or they don't exist anymore, right? Okay, so in terms of discount rates shocks, where we found that the evolution of the discount rates through the yield and the equity risk premia explain well the co-movement of unlisted infrastructure returns and also of other asset classes. That, well, thankfully that's the case. That's, after all, what is supposed to happen. In terms of stress, we see that the impact of the equity risk premia increases in returns, in terms of the variance of returns, and the impact of rates is more complex. It's due to a number of things: changes in investor preferences, monetary policy changes, the fact that rates are very low or not, etc. So it's more difficult to find a simple pattern like with the impact of the equity risk premia, but clearly there's co-movements between, again, infrastructure and other asset classes, which makes sense and can be explained based on the known history of the asset class and of markets. So I'm coming to the conclusion, which I think is about time. Let me just take you over some of our key findings again. So what have we found with this research? We found that unlisted infrastructure is not immune to market shocks. We found positive, significant, time-varying return correlations between unlisted infrastructure, equity, and both stocks and bonds. That's probably very obvious, but it's also important to acknowledge, because it's not always in the literature. I mean, it's not always in the marketing literature. I mean, we find that these risk premia correlations increase in bad times. So unlisted infrastructure returns become more positively correlated with equities in times of crisis, and equities and unlisted infrastructure also share some tail risk. Right, this was especially the case during two key periods in the history we have: subprime crisis and, more recently, the COVID pandemic. Okay, so this coincidence of losses in bad times, from what we understand, is due to simultaneous increases in the equity risk premia of each asset class, which also makes sense, right? At one point of crisis, investors want the price illiquidity or extreme negative returns more. So there tends to be a higher risk premia for both unlisted infrastructure and listed equities in bad times. So but again, the scale of these effects is not the same, and it's less strong for unlisted infrastructure. We see that all these different shocks, not all of them have the same impact. So this is something that's also a bit more detailed in the paper, but we see that recessions coincide with lower returns through the cash flow channels, but also recessions lead to a general increase in risk premia, again, across asset classes. Financial crises also lead to higher risk premia, but also to a higher level of what's the right word? I'm sorry. Risk aversion is the word I'm looking for. So this is something that means that the role of infrastructure and the way it behaves relative to other asset classes will be different depending on whether we're looking at a recession or for example, a financial market crash, or a policy-driven crisis like COVID lockdown, for example. We also see that there are crises that don't really have an effect, like the Eurozone crisis. We don't see have a big impact on infrastructure, which is consistent with the idea that in terms of extreme risk, in terms of tail risk, there is not much joint tail risk between infrastructure and government bonds. Another thing that appears very clearly is that interest rates risk is really important. We already knew that, but here it's made even more obvious through the role of tail risk, in particular with corporate bonds. Still, so one of the two said, let's say more, despite the fact that we see all this risk, of the two more positive findings in the paper in terms of what the asset class does and where it sits, is that there's good evidence of downside protection. The level of drawdown, extreme losses that unlisted infrastructure exhibits during periods of market stress is lower than in listed equities, and it's often much closer to corporate bonds. So that's a clear sign of a downside protection. And all the results in terms of correlations indicate that infrastructure is good for the portfolio. Whichever way you look at it, it's going to increase diversification. The key here is to access infrastructure in a broad, well-diversified manner. Because of course, these results matter. These results are for an index with 300 assets in it. So it's well-diversified, at least as diversified as it can be with 300 assets. If you're only exposed to 5 or 6 assets, for example, that's quite a different picture, and you might not necessarily be experiencing the same absence of correlations in bad times. Some assets don't necessarily perform very well individually in bad times. In fact, about this, there is in the paper a number of analyses at the sector level, comparing, for example, social infrastructure, which is obviously very resilient in terms of cash flows, but is also, as a result, more exposed to interest rate risk, with assets like in the transport sectors or the utility sectors, which have riskier cash flows, but have more of an opportunity to have cash flow growth, to grow the business, and therefore resist some of the impact of shocks better than more stable but less equity-like infrastructure investments. So there's really some interesting differences between the sectors here, but we don't have time for that today, so I'll let you discover that in the paper. Now, we have a few points for discussion. For investors, I think, I was just saying that these results assume a well-diversified exposure to infrastructure assets, right? This is something that in practice you may find difficult to achieve, because infrastructure is large and liquid, etc. So how you invest across how many funds of funds, or how big your portfolio is, and how you manage to find yourself exposed to these co-movements or not exposed to these co-movements that I just described, depend on your access to infrastructure as an asset class, which goes back to what François was saying initially, which is it really matters to build infrastructure as an asset class, and not just as a, let's say, more of a few alternative bet, right? And that, in terms of prudential treatment, also has implications, because now we can start to develop measures of risk and extreme risk, which confirm the fact that infrastructure should be treated separately. That's already the case in a number of frameworks. But as François was saying, there are currently a number of initiatives to integrate infrastructure in solvency-like frameworks, and these results should be suggest that this is warranted, and we, depending on the metric that you want to use. I haven't talked too much about value at risk today, because that's yet another question in terms of granularity and the ability to measure the tail of the distributions. But there's clearly something that can be done in terms of calibration of prudential models here, that whether they're internal or standard models, to ensure that infrastructure has the treatment that it deserves in the prudential treatments, in prudential frameworks. Sorry. So that concludes my presentation. I see that we have a few questions, but first, François, I think you wanted to say a few more things before we go into the questions.
Very briefly, because I'm acutely aware that we're over the allocated time slot, even though we still have close to 100 participants connected. So just a few thoughts. First of all, I mean, there's maybe no particular scoop in this study, but I believe it has the great merit of confirming and substantiating what we all sort of felt as professional practitioners that indeed infrastructure is good for you, it's good for your portfolio, based on the various assumptions or within the constraints or the provisions that you mentioned, Frédéric, but basically whether it's in terms of shortest drawdowns, fastest recovery, more limited extreme loss, diversification impact, it all very much substantiates the benefits of having unlisted infrastructure in your portfolio from a more maybe scientific basis now. And by the way, I invite you all to effectively refer to the full comprehensive report, which will be made available just after this webinar on both EDHECinfra website and our website, LTIIA. You'll find a number of sort of more detailed approaches or analysis, whether it related to sector-wise analysis. You said a few words about them, Frédéric, or in terms of infrastructure business model, regulated, contracted, merchant, in particular with regard to inflation and the possibility of pass-through and how those different categories of inflation of infrastructure might effectively weather interest rate shocks, for example. I believe there was a question about core infrastructure versus value add. I mean, all of this is in some way you'll find elements of response in the full comprehensive report that is now will be made available. Maybe a last thought, and it's one thing to say that infrastructure is more resilient among academic circles or professional circles, as we all are. It's another one to draw operational conclusions, and that's the implications you just pointed to, Frédéric. I believe it's our collective responsibility now, and we'll do our bit certainly at LTIIA to convey and channel these conclusions to well, whoever might be directly concerned with those, and of course, one thinks first and foremost of regulators. So that's what we intend to do in the coming months, to take those findings and sort of showcase and highlight them to well, responsible parties, so that indeed at the end of the day we can get what we see as a needed improvement of regulatory framework, particularly when we face, as we all do, a wall of investment in infrastructure required to face the various crises that we collectively face. So again, very timely and very appropriate conclusions. Now it's on us to make the most out of them. Thank you.
Thank you, Francois. Just if people are still around, I have a few questions. They're quite techy questions, except for one, where can we download the paper? So it will be on our website, if not now, in the next couple of hours. And then, so the question about styles goes back to the question about sub-segments. So yes, you'd have different, if you assume that core and core plus are different mixes of TICs segments, right? More contracted and more merchant, or more of this and more of that, you will find those differences, those same differences. They're quite significant because of the sensitivity of these different types of assets to, well, their ability to grow their revenues and their dividends. And their sensitivity to interest rates and risk premium changes, and also what drives these actually the market price of risk for and their exposure to that. In terms, and then I have a few questions that are really a bit more about the computations. One is, how can we compute these higher order co-moments and be sure that the results are robust? So we have the best data there is, but I would agree that whether it's the exact number that you find, you could challenge from a purely, I would say, a statistical standpoint. I think what's interesting in this paper is that you see differences in estimates that are that are different by 2 or 3 orders of magnitude, meaning that you can see that there's something going on here that's interesting. Whether or not the co-kurtosis is, 650 or 750, it might be something that you can challenge. But clearly it's that number during one period of time, and then it's half that number or zero during another period of time. So there's something going on in this data, which is very interesting and something that we hadn't seen before. And then questions on the availability of the data during extreme events. So we compute these results all the time, and it doesn't matter whether there's a crisis or not. We may have slightly fewer transactions available to calibrate the risk premium, but when it comes to the effect of cash flows, risk-free rates, there's just as much data during extreme market events. So it's a question, it's a good question, but it's not necessarily a big issue in the data. And then another question still from Martin about 12 months rolling correlations. We have looked at those. There's some in the paper actually. So I'll let you look at that, and I'm happy to take an email if you want if you have any questions on that. And I think that covers all the questions I've seen. I'm glad to see there's lots of questions from Quartz who like kurtosis and skewness. And with that, I thank you all. Thank you, Francois, and thank you, LTIIA again. And I think we can leave it at that for today.
Thank you. Goodbye.
Thank you, everybody.